Okay, folks, time is up. Please bring your quizzes in. Yeah. 16. Time is up. No, give it to him. Okay, he's leaving, so your quizzes are not in, they're not in. That's it. Okay. Third and final quiz out of the way, so let's talk real options. So we're into the third packet. If you didn't bring it, not a big deal because we're just covering the basics of options today. But when I first started teaching this class, there was no topic called real options. Okay? So somewhere about 5 or 6 years in, I started teaching the class. And when I first started and put it into my first book, it was novel. People hadn't seen it. Now, a few years later, you went back and checked the books on real options, and consultants had expropriated the word to kind of capture whatever they want. So what I'd like to talk about today is how to separate the wannabe options from the real options. Let's go back, In traditional discounted cash flow valuation, you take the expected cash flow, you discount them back today, you come up with the present value, and that's the value of an asset. But you could argue that there are options embedded in assets that you're not capturing with the traditional discounted cash flow valuation. Let's take a few. You can delay an investment. Doesn't look good today. You can delay it and take it later. The second is you have a production schedule. You can produce less and produce more. There is flexibility in that. The third is you might be able to, if you take a bad project, be able to expand into a much bigger project, potentially adding value. And finally, if you have a really long-term project that is not working out, you can shut the project down. So broadly speaking, it's like life. You have the option to delay, the option to abandon, the option to expand, and you see it play out in projects. And in a traditional discounted cash flow valuation, you're missing it. Put simply, real options give you an excuse for adding a premium to your discounted cash flow value. So remember the DCF value you got for your company? It was 10% below the stock price, but you really, really want to buy the company. Real options become an excuse saying, I'm buying the company even though the DCF value is less because there's an option added. So already you can see the attraction of real options. It allows you to override the numbers and do what you want to do. So in today's class, I'm going to first talk about where the value of the real option comes from, and then use it to kind of set up a platform for the right kinds of questions we need to ask people when they throw the real options argument into the discussion. So let's start with a very simple decision tree. A decision tree where you're sitting here today, there's a 50% chance of success and a 50% chance of failure. If you succeed, you're going to make 100 million. If you're going to fail, you're going to lose 120 million. The expected value obviously is negative, minus 10 million. Now here's what I'm going to do. I'm going to take this decision tree and add a layer to it. So what I'm doing is it's exactly the same total upside and the total downside. 20 plus 80 is 100, minus 100, minus 20 is minus 120. The probabilities are exactly the same as well. There's a 50% chance of success and a 50% chance of failure. but now it's split into two branches. If you take the expected value of the second tree, it is positive. It's almost magical. I took one tree which had a negative value, and then I broke it up into sub-branches, which effectively converted the negative NPV to a positive NPV. So what's happening in the second decision tree that's converting the negative expected value to a positive expected? Give me in intuitive terms what the advantages are. Landon? The cumulative probabilities are exactly the same, 50% up, 50% down. 3/4 times 2/3 is a half, 1/4. So basically, I'm still getting the same cumulative probability of 50-50. So we look at the cumulative effects, it looks the same. What is it that I get in the second decision tree? I get to do a small version of it. And if it works out, then I continue. And if it doesn't, I just stop. Think of it like a test market, right? Essentially, you get a chance to test it out. There are two things that drive the real options argument. The first is you learn as you go along. You're learning in that first branch of the tree, whether this project is a good project or a bad project. And then you adapt your behavior based on what you've learned. Learning and adaptive behavior. I want you to keep that in the back of your head as we talk about it. Shruti? I'm sorry? Because basically, if you look at the total downside probability, you still end up with 50%. But because you lose less in a portion of the downside probability, the expected value becomes positive. So if you look at the 50% chance, 50% upside, downside, the total cumulative values of the upside and the downside are the same. But because I stopped early in this process, I saved myself at the downside. That's where the optionality is coming from, the learning and the adaptive. If I force myself to continue in this, the optionality would disappear. So you need to learn and you need to adapt your behavior to get your expected value to positive. So both components have to come into play. So I'm going to set up the three basic questions I think you will need to ask, because you're going to see consultants throw it, you finance, experts throw it, bankers throw it. There's a real option in here. Here are the three questions you need to ask and get answered before you decide to add a real options preview. First, let's talk about when there is an option embedded in an asset. What are you looking for to decide that there is an option? And I'm going to give you a very simple cash payoff diagram answer that. If you show me your cash payoffs, I can tell you whether there's an option. You're going to see in a minute what I mean by that. Second stop, even if there's an option embedded in action, you got to ask yourself, is there significant value? Is it worth the trouble of going through this process of trying to value? And third, when can you use an option pricing model to value that option? This part of the process would require some revisiting of basic option pricing models. So I'm going to assume you remember nothing from your foundations class on options. And I'm going to go through the basics of what it is that Fisher, Black, and Scholes did in the early 70s that provided a breakthrough that allowed us to value options. So let's start with the first question. When is there an option embedded in an action? Let's face it, options are derivative assets. They derive their value from something else. So the first thing you're looking for is, when I talk about options, what is the underlying asset? So with every real option, I'm going to start by saying, this is the option, this is the underlying asset. Second, all options provide contingent payoffs. Something has to happen for you to get paid off. With a call option, the stock price has to rise above the strike price. With a put option, the stock price has to drop below the strike price. And if you look at any options class, the way you show this is with the payoff diagram. Option payoff diagrams are unique because they limit downside risk. The reason they limit downside risk is you get the right to do something, not the obligation. So the price goes up, you exercise the option, you claim the difference. The price goes down, you throw the call option to the trash can. So this is classic call option, limited downside, potentially unlimited upside. With a put option, you flip the whole thing over. If the stock price goes up, you throw away the put option, but if the stock price goes down, you claim the difference. It's not unlimited because the price can't drop below zero, but it could be very large. The nature of options is you get the upside of risk and not the downside. And already you can see where this is going to lead us to when we talk about the variables that drive an option value. So if I show you a real option, I've got to show you a payoff diagram that looks something like this. If this payoff diagram doesn't show up, there's no option. So let's say you have found an option. And I'll give you several examples of real options. Your second stop is to ask what I think is the key question in real options. Does this option have significant economic value? When do you have significant economic value? When you and only you can exercise that option. There's got to be some restriction on competition. I'll give you an example. One of the things we're going to value as a real option is a patent. What's the protection you get? You get the protection from competition because the government steps in and acts as your enforcer. An exclusive license is an option. A brand name is not quite an option. There's exclusivity, but there's not complete exclusivity. So don't think of this as 0-1, exclusivity, no exclusivity. There's a continuum. The stronger your competitive advantages and barriers to entry, the closer you are to the exclusivity end. The weaker they are, the closer you are to the non-exclusivity end. So is there an option? Is there exclusivity? You're going to start with 100 options, maybe 10 of them have exclusivity. You've already pruned the list of 90. Now we can talk about what drives the value of an option. Options are actually very simple to value because you're valuing them based on the underlying asset. In fact, we know conclusively, unlike with valuing equity or valuing a business, we have all these loose ends. With an option, there are only 6 variables that determine the value of the option. With each one, let's stop and ask why. Think about call options that give you the right to buy something at a fixed price, put options that give you the right to sell something at a fixed price. First, as the value of the underlying asset goes up and down, the value of your options will also go up and down. Tomorrow, after close of trading, Tesla is going to report its earnings report. Stock's down to what, 155? So let's say you buy a put option on Tesla. If you buy a put option Tesla and the stock comes up. Now, so let's say one person buys a call option because they think good news is going to come out. The other person buys a put option. If the earnings report comes out and turns out to be better than expected and the stock goes from 155 to 175, call options will become more valuable because the right to buy at a fixed price just got more valuable. Put options will get less valuable. Value the underlying asset. Second, the variance in that value will also drive the value of the option. The more variance there is in that value, the more valuable both the call and this always strikes people as strange. How can both a bullish and a bearish bet get more valuable? Varying cuts in both directions. So the greater the variance in the value of the underlying asset, the more valuable both calls and puts become. This is why options are so different from every other asset you value, because in every other asset, risk is your enemy, right? Discounted cash flow valuation, raise the discount rate, lower the value. In pricing, we attach a lower multiple to a company that has a higher risk. But once you come to options, risk becomes your ally, both call and put options. Third, any expected dividends on the underlying asset will affect your value as an option. Think of what? What do you get with a call option? The right to buy at a fixed price, right? So let's say you buy a call option on a stock. Let's pick a stock, ConEd. Tomorrow is an ex-dividend day. So there's going to be a $2 dividend. Roughly speaking, what's going to happen to ConEd's stock price tomorrow when you have the ex-dividend day? It's going to drop by roughly $2. As a call option owner, expected dividends will make your call option less valuable because they reduce the expected stock price. And if you're a put option owner, those same dividends will increase value. So there are 3 variables relating to the asset: the value of the asset, the variance in the value, expected dividends. There are two inputs that come from the option. A call option gives you the right to buy at a fixed price, right? That's called the strike price. The higher the strike price, the less valuable the call option becomes. The right to buy at a higher price is worth less than the right to buy at a lower price. And with the put option, it's a reverse. The other is the life to expiration. The more time I give you to play this game, the more valuable all options become. So the variance and the life of the option cut in the same direction for both calls and puts. The 3 other inputs push in different directions. There's not much macro stuff in there, right? Question.
Can you explain again how expected dividends reduce the value of calls?
Because so let's say Conrad, there's going to be a dividend tomorrow and a dividend 3 months from now. They're both $2 dividends. Your stock price is going to drop by roughly $2 tomorrow and again in 3 months. As a call option owner, if you have a 6-month option, you got to factor in that the price will drop, if nothing else, because the dividend gets paid out. So that's why dividends make call options less valuable, put options more valuable, because the price will adjust on the ex-dividend day. There's only one macro variable that affects the value of an option. It's a risk-free rate related to the life of the option. Here's why. With a call option, you get the right to buy a stock at a fixed price. When? 3 months from now, 6 months from now. The higher interest rates become, the lower the present value is of that price. So as interest rates go up, call options will become more valuable because the right to buy at a price, which is in the future, becomes more valuable. Put options, you collect that same cash flow 6 months from now. So as interest rates go up, put options will get less valuable. So 4 of the variables cut in opposite directions. Calls and puts push in other directions. The variance and the life of the option push in the same direction. Any questions about the drivers of option value? So now it's time for some basic option pricing. Okay? Every option pricing model out there, and you might have seen 2. I don't know whether you've seen both in your foundations class. The 2 most widely accessible option pricing models are the binomial model and the Black-Scholes model. I'll talk about both. What they share in common is an insight that Fisher, Black, and Scholes had when they first started looking at options. Prior to the early 70s, the way people valued options is by valuing, like any other asset, take the expected cash flows, come up with a discount rate, and Paul Samuelson in the 1960s, an option pricing model. What Fisher, Black, and Scholes realized was that if you combine the underlying asset and borrowing and lending, you can create something that looks exactly like the option. It's a process called replication. It's going to sound mysterious, but if you tell me what call option you bought, I can create what's called a replicated portfolio, combining the underlying asset and borrowing or lending. You're saying, so what? Option pricing models are built on replication and arbitrage. What I mean by arbitrage is if the option and the replicating portfolio both have the same cash flows, arbitrage requires that they both trade at the same price. Replication plus arbitrage is the basis for every option pricing model. So whether you use Black-Scholes, binomial, and with the binomial, I'll show you how it works out, and then we'll extend to Black-Scholes. You're doing replication arbitrage. Let's say you have a real option and you decide that you're going to price it using the Black-Scholes model. Okay, I can come up with the inputs, but here's the problem. What's the underlying asset in a patent? What do I get the right to do? Develop that patent into a commercial product and produce cash flows, right? That's the underlying asset. It's not traded. The patent is not traded. The underlying asset is not traded. Using an option pricing model becomes much more difficult to do when the underlying asset and the option are not traded. Real options, where we use option pricing model, you got to be careful what you get out of it because you're applying a model built on replication to things that might not be replicable. It doesn't mean you can't use an option pricing model to value a real option. It just means that the value you get, you can't act on as much. It's not monetizable. So with that lead in, let's talk about a little bit of option pricing. 1971, Fisher, Black, and Scholes were both at the University of Chicago, and they were thinking about how to value options. And essentially, they started playing with, how can I create something that looks exactly like the option in terms of generating cash flows? And they discovered that if you have a call option, borrowing a certain amount of money, and for the moment, it's going to sound subjective. What do you mean certain amount of money? But we'll have to specify how much. And buying a certain number of units, again, a kind of a fuzzy thing. How many units are you going to buy? Can create something that looks exactly like a call option. Borrowing money and buying the underlying shares create something that looks like the call option. That's why call options are just heavily levered equity positions. Now, it terrifies me when I see these YouTube videos, and especially in markets like India, where people want to get rich in a hurry. And they want to get rich in a hurry in every market. But in a sense, they've never seen things like options. I see dozens of YouTube videos being sent to me, say, what do you think about this? And what the YouTube video is about how to use options to get rich. As if options are a different instrument. And the point is, options are levered equity positions. Of course, you can get rich in a hurry. And of course, you can get poor in a hurry. And unless they're mispriced, you're not going to get rich and stay rich because the mispricing is what drives richness importance. But basically, call options are just levered. It's like borrowing money and buying stock. So even before call options were around, you bought stocks on margin. Effectively, you are creating an option position. With a put option, you sell short on the stock and you lend the money out. You can create something that looks exactly like the put option. So every option pricing model is about figuring out what that replicating portfolio will look like, because once you've done that, you're home. You basically can value the option. So Black-Scholes model comes out in 1971, and it's taught in classrooms, and people talk about replicating portfolios, but you really don't see them. So say, Rob, what is this replicating portfolio? In the late 70s, professor at the University of California at Berkeley, Mark Rubenstein, said, let's see how we can show people what a replicating portfolio is. And he used a binomial model to illustrate it. Binomial model, a stock can jump to only one of 2 points. It's a very limiting model if you think about it, but it's going to help us illustrate the process of replication. So let's say you have a stock that right now is trading at 50. Next period can either be 70 or 35. That's t equal to 1. And if you wait 2 periods, the 70 can go up to either 100 or 50, and if it goes to 35, it can go to 25, 50. So basically, at t equal to 2, the stock price can be 25, 50, or 100. Let's suppose I gave you a call option with a strike price of 40. That's what the call option is granted to you today. Let's go to t equal to 2, which is when the call option expires. If you have a strike price of 40 and the stock price goes to 100, what's your cash flow going to be? What are you going to do? You're going to exercise your right, buy the share at 40, turn around and sell it at 100 and make $60. Everybody with me so far? Stock goes to 50. Again, you'll exercise at 40, sell it at 50, make $10. Stock goes to 25. You'll exercise at 40. No, you don't have to, right? It's a right. So the stock goes to 25. What do? You don't exercise. You have zero. In terms of gross cash flows, your cash flows are going to be 60, 10, or 0 at t equal to 2. Here's what I'm going to try to do. I'm going to try to create a replicating portfolio at each stage, which has exactly the same cash flows as the option. The nature of option pricing is I know the cash flows at expiration. I've got to work backwards. So all binomial models, you start with them. So let's start with the outer limits of this. So if you look, if you look at the stock price being 70, you say at 70, how do I create a replicating portfolio that will give me 60 if the stock price goes to 100 and 10 if it goes to 50? So let's assume for the moment that you borrow B dollars. Hang in there with me because it still sounds abstract. And you buy delta shares of stock or D shares of stock. So you do that at the stock price of 70. Stock price goes to 100. What's that position going to be worth? The shares you bought are going to be 100 times delta. You have to pay back the borrowing with interest. So let's say the interest rate is 11%. You pay it back with interest. So if the stock price goes to 100, your cash flows are going to be 100 times delta minus the borrowing paid back with interest. And it's got to be equal to 60, which is the cash flow on the call. If the stock price goes to 50, your position is going to be worth 50 times delta minus the borrowing paid back with interest, and that cash flow is to be equal to 10. I know it's been a long time since you did simultaneous equations. But if 2 equations and 2 unknowns, trust me, eventually there should be no unknowns. So I solve for it. So if your simultaneous equations are rusty, these are very simple simultaneous equations. Just you have to either get rid of B or you got to get rid of delta. My wife teaches 5th grade. She's starting on the process. So one or the other has to disappear. You can't have 2 unknowns. And if you work long enough and hard enough, you can solve for delta and B. And it turns out that delta is equal to 1 and B is 33.96. You think, what does that mean? If the stock price goes to 7 and I go out and I borrow $36.04 and buy 1 share of stock, I will have exactly the same cash flows as buying a call option with a strike price of 40. I've created my replicating portfolio. How much will it cost me to create the replicating portfolio? I borrow $36.04. So that's not my money. I buy one share of stock at 70. That's my money. That difference, $33.96, becomes the value of that call option with the strike price of 40 if the stock goes to 70. I know it's messy because your math might be a little rusty, but basically what I'm trying to do is create a position that has the same cash flows in the call. And you can see why I've always have to start with the last branch and work backwards. So now I know what the call is going to be worth if the stock goes to 70. Let's say the stock goes to 35. I repeat this process. I borrow B dollars, I buy delta shares of stock. If the stock goes to 50, 50 times delta minus 1.11 times B has to be equal to 10. And the stock goes to 25, 25 times delta minus 1.11 B has to be equal to 0 because the cash flows are what's on the option is 0. Again, I do the simultaneous equations. And now the answer I get is B is equal to $9.01. And I have to buy 0.4 shares of stock. Don't even ask me how you buy 0.4 shares. Kind of act like you can buy fractions of shares. How much is that going to cost me to create? Well, 0.4 shares of stock at $35 is $14. You subtract out the $9.01, I get $4.99. Now I have the value of the call option at T equal to 1. It's going to be worth $33.96. The stock goes to 70 and $4.99 if the stock goes to 35. Now I can go back to T equal to 0. And I repeat the process again. If stock goes to 70, which is the intermediate stop, minus 1.11 times B, the value has to be equal to $33.96, the value of the call. This is not just replicating, but it's self-financing. Once I create that upfront position, and the upfront position is I have to go out and borrow $21.61 and buy 0.8278 shares of stock. I've created a position that's going to look exactly like my option at every branch of this tree. So think I'm an investor. I can buy the call option at the strike price of 40. I get these cash flows. Or I can go out and borrow $21.61 and buy 0.8278 shares of stock. And I've created a position that looks exactly like the call option. That's a replication. Where's the arbitrage coming? It cost me $19.42 to create the replicating portfolio now, right? If the call option sold at any price other than 1942, you can make riskless, guaranteed profits. Let's say the call option sold at 20. Tell me what you would do as an investor. No, don't borrow as much as you can, right? Basically, you will buy the replicating portfolio, you will sell the call. So the replicating portfolio costs you only $19.42. You sell the call for 20, you claim the 58-cent difference now. And remember, from this point on, the cash flows in the two positions will offset each other. You can sit back and say, that's pure. That's why we use the word arbitrage extremely casually in investing. True arbitrage requires both. Essentially, it's riskless and you don't need to make any investment. You've locked in a pure profit. So the call cannot trade for more than 1942 because if it did, I would buy the replicating portfolio, sell the call, claim the difference. The call can't sell for less either because it's sold for less. I'd sell the replicating portfolio, buy the call. Option pricing is held together by the strongest of forces in finance. It's not some expectation or theory, it's arbitrage. You know why arbitrage is so powerful? Because greedy people are what make markets efficient. So if there's arbitrage, they will find it. They will exploit in the process. They will drive the two together. That is binomial option pricing. Just take a look. I know it looks messy, but it's a great way of understanding replication and arbitrage. Much better than you do in the Black-Scholes. I'll show you where these things are in the Black-Scholes. They're kind of hidden, but in the binomial, they're up in your face. Any questions on the binomial option pricing model? The binomial option pricing model is kind of limiting though, right? The stock can jump to only 1 or 2 points in the next time period. I mean, think about a stock like Tesla at the start of today. To ask you, what is the possible price at the end of the day? It's definitely not going to be 2 numbers. It's going to be dozens and dozens of numbers. To have any chance of a binomial tree even holding, time has to get really short, right? A second. Maybe if I made 1 second time intervals, maybe in the next second, the price can jump to only 1 or 2 points. So here's what I'm going to do. I'm going to take the binomial and see what happens as I make time shorter and shorter. The time intervals can go from a month to a day to an hour to a minute to a second, and see what happens to the binomial model.
Would this be useful then for like more discrete decisions?
It can be useful for something. I mean, even there, like a pharmaceutical, drug, it's really the binomial. The only reason it's useful for you to understand where the Black-Scholes is coming from. That's really the entire purpose of the binomial. I've never seen somebody use the binomial in its full form to value an option, but if you understand the binomial, you can understand the Black-Scholes much better. So let's say you took time and you compress time intervals from a day to an hour to seconds. Imagine that you have a 3-month option and you're drawing a binomial tree in 1 second intervals. Imagine you have to sit there with a magnifying glass, the branches have to be, let's say you are very, very, very patient and you do it. So let's say you've drawn the binomial tree. How many seconds are there in 3 months? I'm not expecting anybody to know the answer, but you can see the number of branches you're going to have are tiny and thousands. So already you've drawn the binomial tree for 3 months in 1 second intervals. I want you to, so when you're done, the binomial, when you've drawn the binomial tree, I want you to flip the tree on its base. What does it look like? It looks like a Christmas tree, right? Basically. Now smooth out the edges of the tree. So basically you're taking a Christmas tree, which is these. And what does it look like if I smooth it out? What kind of distribution? It looks like the normal distribution. If as t gets smaller, price changes also get smaller. It's called a continuous price distribution. The binomial distribution converges on the normal distribution as time periods get shorter. But only if price, so you know in the continuous price world, how the stock gets from 30 to 55. It goes 30, 30.05, 30.1, it doesn't jump. So basically in the continuous price world, prices move continuously and the binomial model becomes the Black-Scholes model. But there is this problem, right? Can the price of Tesla jump in the next minute in the real world? Yeah, in the real world, prices jump all the time. Black-Scholes models were designed for continuous price processes. So when you have big price jumps, the model tends to break down. We know conclusively, for instance, that using the Black-Scholes model undervalues deep out of the money options. Do you see why? Because in the Black-Scholes, you know, a deep out of the money option, the stock price is way below the strike price. So in the Black-Scholes model, you can say there's no chance I'm going to get from 30 to 55 because I've got to work in these tiny increments. It's going to take a long time. But the problem there is with the model assuming prices can't jump. In a world where prices can jump, I guarantee you, if you buy a 2-day option tomorrow in Tesla before the earnings report, and it's an out-of-the-money option, it's not going to be cheap. Because there is a price jump coming. You don't know in which direction. In fact, some of the biggest failures in investing have come about because people have used Black-Scholes models to design products where the price jumps are common. Okay? I'll give you my favorite example. In the 1980s, if you're a portfolio manager, I'm going to offer you a product and you tell me whether you'd be interested. So in the 80s, stock prices are rising. Your portfolio that was $1 million 10 years ago is now 8 million. And you're worried, right? The prices have gone up a lot. You say, maybe price will, very similar to where we are now. You're sitting on a huge amount of profits. Now you could always sell your stock and convert to cash, but you don't want to do that. You're an equity mutual fund manager. So here's what I do. I come to you with a product. It's called portfolio insurance. And what I offer you is, if you buy my product, your portfolio will never drop below 7.5 million. How would I offer that product? What kind of option have I just given you? You're going to be always, so it's almost like I've constructed a put option on your portfolio, right? That's what portfolio insurance was. It was this firm called Leland O'Brien Rubenstein creating these synthetic puts. So they would take your portfolio, create a put based on the portfolio using that replicating portfolio. And then say, don't worry, your portfolio will not drop more than $500,000. It worked. In fact, they had huge growth between 1985 and 1987. And then came October 19 of 1987. Remind me again what happened on October 19th? The S&P 500 dropped 22%. All those portfolio insurance products, so you are a portfolio manager. I said, good, I bought insurance. And then at the end of the day, you got a call from Leland O'Brien Rubenstein saying, you know the insurance you bought? It didn't work today. He's saying, this is exactly the kind of day I bought it for. But they designed the put using Black-Scholes models, so basically the replicating portfolio blew up because it wasn't designed for price jumps. So when you look at the Black-Scholes model, remember, not only are you making the assumption of replicating portfolio, you're assuming that prices move continuously. There are versions of option pricing models built around jump processes. They've never caught on. They've been around for 40 years. The reason they've never caught on is getting the parameters for jump processes is incredibly messy. So people have stayed with the Black-Scholes model, recognizing that it is going to probably undervalue options that are deep out of the money, but recognize that that's a feature. The other component of an option is I told you get the right to buy something at a fixed price over the next 3 months, right? That's called an American option. You can exercise it at any time over the next 3 months. It's unfortunate we have a geographic name. It's got nothing to do with geography. But there are European options. What's the difference between an American and a European option?
European option only can be executed on the date.
So if I give you a 3-month European option, you can exercise it only on the last minute of the last day. So holding all its constant, we have a European and an American option, exact same characteristics. Which one should be worth more? The American should be worth more. How much more will depend upon how likely it is that early exercise works out in your favor. You know that 95% of options in the CBOE never get exercised early. They're very much like European options, even though they're constructed as American options. Why not? Why does it not make sense to exercise early? So let's say you buy a call option in Tesla tomorrow at a 170 strike price. Earnings report comes out, turns out to be much better than expected. The stock pops to 180 for open of trading the next day. David, why would you not exercise?
Before the trade keep going up.
And how would that help you?
The option is going to be valued more than the other.
There's going to be a time premium on the option. So instead of exercising the option and getting $10, you're going to sell it to somebody at what price? $12, $13. With listed options, it almost always makes sense to exercise early. There are a couple of exceptions. Remember we talked about a Con Ed paying a $2 dividend? Just before a big X dividend day, you can sometimes find that early exercise beats holding on. The time premium is smaller than what you can get. That's the exception rather than the rule. But Black-Scholes was designed to value European options. So let's go back to 1971. Fisher Black and Myron Scholes are trying to come up. They've created this replicating portfolio, and they're trying to figure out how to solve for delta and B in a normal distribution. And they discover themselves in this entirely new area of math we've never seen in finance called stochastic calculus. And they're stuck. It's this big equation. They don't know how to take the derivative in stochastic calculus. Rumor has it, it stayed on their desk for a few months until a physics PhD student was wandering through, came by and said, oh, we deal with this, it's called Ito's lemma. This is how, so the Nobel Prize should actually have gone to Fisher Black, Myron Scholes, and the unknown physics student who solved it. In the original Black-Scholes, the value of a call option was listed as a function of 5 variables. And I list the 5. I want you to think about them because I listed 6 originally, right? So I'm going to list the 5 and you tell me what the missing variable is. S, which is the current value of the stock. K, which is the strike price. T, which is the life of the option. R, which is the riskless rate. And don't ask me why. Microsoft Office and the PC seems to turn my sigmas all to question marks. But this final thing is the sigma squared, the variance. SK, RT, and sigma, what's the missing variable? Dividends. You're saying, why did they ignore dividends? Remember the math problem they were having? They realized if they brought dividends in, it got even worse. So they did what economists do. They assumed away the problem. The original Black-Scholes was designed to value what are called dividend protected options. You're saying, what's a dividend protected option? If the stock pays a dividend of $2, remember I said the stock price drops by roughly $2, and you heard because your strike price is fixed. With a dividend protected option, when a dividend gets paid, as the stock price drops, your strike price is also adjusted down. How many dividend protected options have I seen in the world? None. But the original Black-Scholes was designed for either non-dividend paying stocks or dividend protected options. So let's look at the actual Black-Scholes. And as I go through this, I want you to think about the replicating portfolio in the binomial distribution. You've all seen this, right? It's a rite of passage to get an MBA. And it makes you use those virgin buttons on your calculator. The value of a call is S, which is today's stock price, times N of D1. You're saying, what the heck is N of D1? I'm not ready to do that, right? But D1 is a function of SK, RT, and sigma. And D2 is D1 minus sigma times square root of D. N of D1 and N of D2 are areas under a normal distribution. Let me repeat that again. When we do statistics, we look at the height of the distribution. N of D1 and N of D2 are areas in the distribution. So the way to read it is, if you tell me what the D1 is, I'm looking at the area of the distribution. So the higher D1 becomes, it's also a standardized distribution. What does that mean? The total value is 1. So basically, if you get all the way to D1 being 15 or 20, N of D1 approaches 1. I know it sounds weird, but that looks a lot like a probability, right? N of D1 and N of D2 in a Black-Scholes model actually take on the roles of probability. The more in the money an option becomes, the more towards 1 both numbers will become. In fact, N of D2 has a very specific reading in an option pricing model. It's called the risk neutral probability that your option will be in the money. Let me repeat that again. So if you see N of D2 in an option is 0.75, roughly speaking, there's a 75% chance that S will be greater than K by the time you get to D. So N of D1 and N of D2 are areas in the distribution. You're saying, what's KE minus RT? I told you there are buttons in a calculator you never use. Remember that exponential button? That's what the E minus RT is. You know what E minus RT does to the strike price? What did I say the Black-Scholes was designed to do? Value European options, right? So when do you have to pay the strike price? 3 months from now. E minus RT is just a present value factor. I've told people you don't have an exponential button in your calculator, just use the present value button. It'll give you roughly the same answer. But in continuous time, E minus RT is a present value factor. So here's what I have. The value of the stock today, which I can observe, times N of D1, which I can estimate because all the variables that go into D1 are observable today, SK, RT, and sigma, minus the present value of the strike price times N of D2. But wait, there is more. Embedded in the Black-Scholes is your replicating portfolio. The N of D1 is called the option delta. Remember the delta that I solved for in the binomial? N of D1 is the number of shares of stock I would buy to replicate the portfolio. One of the problems with people using Black-Scholes, they plug the numbers in, they get the output, but the real value in the Black-Scholes is not in the value that you get as output, is in the intermediate steps. So when you tell me N of D1 is 0.88, you're telling me buy 0.88 shares of stock. And borrow KE minus RT times ND2. So the delta and the BU and the binomial are embedded in the Black-Scholes. I know option traders like to keep the rest of us at bay. You know how they do it? They steal the entire Greek alphabet. Everything in option trading is some variation of what happens in the replicating portfolio. For instance, you take, let's say you replicate a call and the stock price changes tomorrow. Will my replicating portfolio change when the stock price changes? Absolutely. It's called the option gamma. Let's say that I have a 3-month option, but that becomes a 2.5-month option, then becomes a 2-month option. As T changes, will my replicating portfolio change? Absolutely. That's called the option theta. I create an option, a replicating portfolio today, and the standard deviation is 20%. Now, after the Tesla earnings report comes out tomorrow, I decide it's going to become 30%. If the standard deviation changes, will my replicating portfolio change? Yes, it's called the option vega. I told you they stole every alphabet out of the Greek alphabet. They're all about what will happen to my replicating portfolio if things change. The stock price changes, the life of the option changes, and the standard. You're saying, why would I care? If you're a banker and you have a bunch of open positions, you know what you need to do, right? You need to hedge those positions. If you don't know how to create replicating portfolios, you're going to be completely exposed. This allows you to hedge positions which are open, even if there are no options, by creating what are called synthetic options. So if you can create a replicating portfolio, you have a way of creating a homemade option. So if you look at ND1 and ND2, you can notice the lowest number we can have is 0, which will happen if there is 0 chance your option will ever be exercised. The highest number you have is 1, which means it's 100% chance, and everything else will fall in the middle. So think of N of D1 and N of D2, not just as areas in the distribution, but probabilities associated with whether your option can be exercised. Yes, Justin.
How is N of D2 lower the price of the, you said,
I'm sorry?
N of D?
And of both
D1.
D1 and D2, the only thing that separates them is the sigma. As the sigma goes towards 0, D1 and D2 will converge on each other. The higher the variance, so think of this as a range of probabilities created by the fact that there's a lot of price movement and uncertainty. That's what the sigma is capturing. So D1 and D2 are driven by exactly the same variables and separated by the sigma in the stock. So that was Black-Scholes 1971, and it was designed for dividend protected options. CBOE starts almost around that time. Chicago Board of Options, you have listed options, and people are pricing options. So this is real life. This is not some abstraction. And guess what they're running into? That companies pay dividends, and the Black-Scholes model doesn't have dividends. So I'm going to close today with what people did to bring dividends in. And when I describe it, you're going to see it's pretty intuitive. What's a replicating portfolio? I borrow money and buy the stock, right? And I buy the stock and it pays a dividend. I will collect the dividend on the stock. So that's why you saw, so if you have a stock that pays a dividend, here's what happens. When I borrow money, I pay an interest rate. Let's say it's 5%. But let's say I bought a stock which has a dividend yield of 2%. Net, I'm really paying only 3%, right? I can use the dividends to pay. It's called a carrying cost. So the first thing you will notice in the D1 and D2, you will now see a dividend yield show up netting out against the risk-free rate. So intuitive. The second thing I told you is when a dividend gets paid, the stock price is going to drop, right? So what you see in the adjustment is I've taken the current stock price and reduced it. So again, it looks like a present value factor, but I'm reducing it by the expected dividend yield. So if I have a 2% dividend yield, I'm saying my price will drop by roughly 2% for as long as I hold this option. So the two adjustments you make for dividends is one, you adjust the stock price for the expected drop from the dividend yield. The other is the carrying cost is now lower because the yield offsets some of the interest rate you have to pay on the borrow. In most real options, this is the version of the Black-Scholes we're going to be using because in the real world, there's some variant of a dividend that you're going to have to deal with. And this model brings dividends in through both D1 and D2 and into the adjusted stock price. So next session, when we start, we are going to start with why you have this dividend yield in real options, but we'll use it to look at a bunch of real options, starting with patents and natural resource reserves. But we're going to use that insight to drive the valuation.
What did you mean by